Hi, my name's Derek Weiss. I'm in the KPMG Insurance Audit Division. I'll be talking to you about my article in the Insurance Survey, Facing Facts, Things Can and Do Go Wrong. This article was really the result of two things. The one angle was something that I've just been interested in myself, certain insurance failures that took place in the early part of this century, which was sort of before my time and I was quite interested in getting to know about. And then looking back at those insurance failures in terms of the current legislation and the way the market is changing, there's a whole raft of legislation coming out which applies to insurers, and seeing if this legislation would have actually prevented those failures previously. So that was the context of the article. The article itself deals particularly with the Rentmeester scenarios, Sage Life, more recently Resolution Life. And then in light of the proposed changes with the Twin Peaks methodology, we also thought it was important to look where those relate to prudential regulation, to look at some of the market conduct angles. And so we also looked at a few of the cases that went to the Enforcement Committee of the Financial Services Board. So that was the context of the article. The stuff that I really felt came out of it that spoke to me quite strongly was about the importance of independent non-executive directors, particularly in insurance. The role of the executive is to make strategic decisions about underwriting and investment policies, and they aggressively pursue these, and therefore you need a strong voice to challenge them at an executive level, and therefore the independent non-executives provide this voice. And I think those could have had an impact. They wouldn't necessarily have avoided these insurance failures. Another angle that came out strongly was the ORSA as envisioned under the new solvency assessment regime. So the ORSA is the Own Risk and Solvency Assessment. A robust ORSA process would definitely have helped to limit some of the exposures that these companies had, help them think ahead in terms of capital planning and capital budgeting, and although not necessarily avoiding these failures, it could definitely have helped. And then the last point was really just that in the modern regulated environment of insurers, there is no longer an option about having a compliance officer and a risk officer. So this article I think will be interesting to exactly those people, executive management and non-executive directors. It will also be interesting to the compliance officers and the risk officers and anyone involved in the SAM process. If you would like to contact me about the article, my name is Derek Weiss, that's DEREK, _VICE, @kpmg.co.za.